Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Frank Holmes. He's the CEO and Chief Investment Officer of U.S. Global Funds, which specializes in natural resources and emerging markets investing. Of course, if you have been in the markets for any length of time, you've certainly seen Frank's friendly face on television numerous times in all the major networks. Thanks for joining me again, Frank.
Well, it's great to be back, Jay.
Always good to talk to you, and I just, you are a man that comes up with different ideas, and that's what I really like about you. You're always, it's not warmed over pablum with you. You're always coming up with different ideas, and your newest one, launching this, your JETS, that is the ETF, U.S. Global JETS ETF, trades on the New York Stock Exchange under the symbol JETS, J-E-T-S. The airline industry has been hurting for some time, Frank, and I can remember sitting in an American Airlines seat and coach, sitting next to a pilot, and way back in the back, he had to take the middle seat because he was flying free on American Airlines. And we were talking, how could this plane be filled, and American Airlines still losing lots of money from Dallas to New York, I think it was flying. And the airlines industry was in tough shape, but it's doing quite well now. But I'm wondering, was it what caused you to decide now to launch this ETF called JETS?
Well, I was getting nowhere complaining. I flew on a regular basis. I fly 100 times a year. Last month I did around the world carry on in 7 days. So I'm a regular, passenger of the air. And I just noticed the fees are going up, and the change fees, and the delays, etc. So I noticed that there was a flight from nonstop to San Antonio to Seattle, and it was Alaska Air. I said, wow, that's a brand new flight. This is going back several years. And I said, this is interesting. I said, 1/3 the cost of American, leaves at a great time, perfect experience. So I started analyzing the company, and it met all my tests for growth in revenue, growing at more than 10%, 20% growth in earnings and cash flow, and 20% returns on equity. So I bought it the Holmes fund, and it doubled. And I became quite interested in sort of better understanding what was taking place with the industry. And what I noticed is that there was an ETF around. It was under the FAA symbol, and they shut down just at probably the best time to open one, and that was after all the restructuring, like American Airlines went bankrupt. If you take a look at the several of the majors, they grew by acquisitions, and what happened is they cut back 25% of the flights, and then they cut back the number of basically those number of flights, and then they took out the bathrooms on some of the extra bathrooms on airplanes and added more seats. So then let's say they went from 150 seats to 165 seats. Now there's 25% less flights available, so they get to charge more, and they have more seats. They have more revenue per flight.
Sure.
And that was a big turn, and then they started charging it for everything. Every cost you could think of, they were charging. And what that did is gave them additional revenue. Like on Bloomberg today was commenting that Delta charges $200 and they used to charge $25, that they're making $3 billion a year from the additional fees. And upon the research, I found that between 2007 and 2013, all these additional fees for baggage, etc., was a revenue generation increase 12-fold, from less than $3 billion to over $34 billion.
Wow.
And so these airlines like the JetBlues and Southwest were already doubling before the price of fuel fell and tripled. So now with the lower fuel charges, they're just making so much money. And in the first quarter of 2015, they made $3.5 billion in free cash flow. And only a year ago, it was only $700 million. That's a 5-fold increase.
Wow. So do you think, to what extent has that growth in earnings been discounted into the market? Do you think it's fully? You think these things are fully priced or close to it right now, Frank?
Not even close. If you look at the iShares ETF for transports, and jets are only 15% of it, trains and trucks dominate that ETF space, that sector of the economy. They trade at 19 times earnings. Jets trade at less than 9. You have a lot of doubt and skepticism because previously in other cycles, and anytime this industry made a lot of money, they undercut each other, they started many additional flights, etc., and it was sort of self-sabotage. It's not going to happen this time. It's a very different discipline. We've witnessed for the first time where American Airlines CEO says, pay me all in stock, not income. Give it to me in stock. You have other airlines doing it. You have Delta saying we're going to increase the dividend by 50%, and we want to do a $6 billion buyback. Now, in the first quarter of this year, S&P 500 biggest companies increased their dividend by 15%. Airlines, 98%.
Oh. Oh. Well, I wonder, Frank, what's made the difference then, I guess, is this consolidation. I'm looking at at some information that you put out from U.S. Global, and it's showing all of these consolidations, and I was even forgetting some of them. You had American Airlines TWA, and before that you had America West and U.S. Airways. They combined, and now those all four airlines are into one. Is that the top? Is that the best one right now? Do you think that's the most undervalued one, American Airlines?
Well, it is very, very inexpensive, and so is United. I think you still get a better experience with American than United. When people, if you look at readable blogs and the passenger experience. But what the ETF did, what we did was we said, here are the four big horses. And that's United, it is American, it's Delta, and it's Southwest. They're the oligopoly that capture the most of the travel, both domestically and across going over the ponds of the Atlantic and the Pacific. So then we said, okay, how do we create something that dynamically adapts globally? And so what we did is we created this ETF that 12% will be in those four big guys, and which is 48% rebalances every quarter. And then we looked at other jets that are growing at the fastest rate, have the highest returns on capital, and we also included Boeing because it manufactures the jets and some of the jet manufacturers. And then for globally, we picked 20 companies that are in the airline industry they're capped at 1% to manage the risk and capture the opportunity. Well, what's really interesting there is that when you go to Mexico, you can buy airports. Beijing is a public company, and you can buy the airport. And these companies basically are like private equity toll gate bridges, and they grow every year. It seems like at 15%. Last year, the Macquarie's airports jumped by 60%.
Wow. So you're actually owning the airlines, the airports.
Yeah, when you leave America, you can own airports, and so there's I think 3 of them are listed in New York from Mexico. So you fly down to Cancun or Acapulco for a holiday, and you're probably landing in a public company, and it's a toll gate.
Do you own foreign carriers as well?
We do, as long as, Jay, they meet the fastest growth in revenue and have the highest returns on capital. That's very, very important to us because we went back and did a lot of data mining, which is called smart beta, and we looked for the factors that allowed it to adapt and adjust to all the bankruptcies, all the restructuring. It caught Southwest Airlines. It was in JetBlue early as a turnaround, etc. And so we applied those factors, and we went back and compared 1, 3, 5, and 10 years. So those companies that make it a total of 33 names, they have to qualify for those key fundamental factors.
Oh. Well, and so you rebalance how often?
Once a quarter.
Once a
coming
quarter.
Up for rebalance, and some of the companies, they'll be removed, and some will be coming in. The 3 big horsemen will remain up there because of sheer cash flow and sheer market cap and liquidity. But after that, it's really a race. So basically, you're seeing 70% of the portfolio are jets and airlines. So it's very torqued to that industry. There's no other ETF. And what I'm really proud about is that in the first 3 weeks, it started trading such great volume that we have stock options on it.
Yeah,
so
I noticed
that. You can buy the ETF and do cover writing.
Yeah, you can make some more income that way. Huh? That's well, it's certainly very interesting, Frank. Thank you very much for passing your information. And of course, people should go to your website to learn more about this and a whole host of funds that you have there. U.S. Global was it usglobal.com? I guess I should know by heart your website. But in any event,
usfunds.com. It's nice and easy.
Yeah, nice and easy.
usfunds.com.
All right. So I want to ask you a little bit because you are a globetrotter, as you just noted. My goodness, around the world in not in 60 days, but in 7 days. It must. Gee, I don't know if I could take that, Frank. But in any event, you spend a lot of time. I know China and India are two of your two countries that you have, at least in recent past, been very, very bullish on. Still so?
Yeah, I think it's so important, Jay, to follow these two countries because they are 40% of the world's population. And when you look at purchasing power parity, last year, surprisingly, China surpassed the U.S. Now, our GDP is much higher, and our GDP, when you take a look at the overall factors, but this purchasing power is significant. India surpassed Germany, has surpassed France. So when you look at America and Chindia, that's pretty well, to me, the economic engine of the world.
Uh-huh. All right, so in India, let's just like to just have you maybe make a couple of comments on that. Prime Minister Modi, he's been in office for over a year now, and you noted that in a recent blog that you wrote that the results of his economic policies have been mostly positive. What kind of policy changes did he put in place that might have helped improve things in India?
I think one of the biggest was a vision that every child would be able to have electricity so they could read, and that emotional excitement that took place as a little boy for him. Mm-hmm. And he had shown that by streamlining bureaucracy, that you could unleash the intellectual capital and also the financial capital. So I think that those type of vision, along with policies of streamlining, started seeing more confidence going into their economic engine. They've also been blessed with lower oil prices. That's been a wonderful win for them because India imports a lot of oil. So that's allowed him the flexibility to implement his policies for infrastructure build-out. He's trying to do as much as he can to catch up to China that has been on turbojets in spending money on building out their infrastructure.
Mm-hmm. What could you talk a little bit about some of the demographic factors that bode well for India? Population, I know that's certainly one, right? That's the one. It's a young population.
They also speak English.
Yeah.
There's so many services that are outsourced for technology that you can get an extremely educated workforce that work at nighttime. There's so many companies in America that outsource quantitative analysis to India. In fact, we partnered with Index Group that are in India for our ETF. Back testing our analysis and making sure that there's an independence that with that creation of that ETF. So I think that there's tremendous opportunity that you have a democracy, the biggest democracy in the world. You have English language, and you have I guess you would say, a real thirst to fast track and be competitive with China in that global arena. And Modi, he grew basically his province, which is like the state of California, faster than China's grown for the past 12 years. Mm-hmm. So he has a track record of doing that in a massive area. So I think that these are the positive parts for him. I think the other parts is what they're trying to do in education is very significant for raising the bar. And I've mentioned this before. There's 600 million people under the age of 25, and they're all wired. They're all hooked up with smartphones. They all want that American dream. So I think that these are very significant demographic features, whereas China doesn't have such a youthful population. They're fast-tracking on aging demographics.
Yeah, well, so certainly is the case, and you would think then the relationship between India and China, is it somewhat contentious? It's not as close, perhaps, as China and Russia right now.
I would say it's improved from 10 years ago.
Uh-huh.
That's what I would say.
what funds, Frank, at U.S. Global would you buy if you wanted to get some exposure to India and China?
Well, I think that our particular fund is more geared in the whole region, and that's the China region opportunity, excluding Japan. But it doesn't invest directly in India. But it'll be in Thailand, it'll be in Taiwan, it'll be in Korea, and mainland China. It has 10% in the A shares. We caught that early last year. I think when I was on the program, 9 months ago, commented on the breakout taking place in China on the A shares. So I think the China region, and there's a wonderful young analyst that's studied in America, Shin, that's with us here in San Antonio. He's from Shanghai. He does a great job. The fund's performing exceptionally well. So I think that's probably a great way to play that whole region.
Okay. Yeah, let me ask you about the H shares, the H as in Hillary, I guess you might say. I'm trying to think of a word that starts with H. The H shares are half the price of the A shares, you wrote recently in a blog. Well, for those of us who don't follow China investing as much, can you explain what the H shares are as opposed to the A shares? What's the difference?
Hong Kong. So when some of the companies that were listed in Shanghai and Shenzhen they qualified to get listed in Hong Kong, they had to have a different set of shareholders, and mainland Chinese could not buy. So it's the same company, same financial reporting, but the liquidity in the interior of China is far greater. So that same company trades at a 40 to 50% premium to the exact same company listed in Hong Kong called H shares.
Well, quite an arbitrage opportunity for someone, I would think.
Yeah, and I think it's a matter of time. You know, I think what's really important for the gold investors to recognize that China wants to become part of as a global currency and respect it. The whole thought process, they've become a significant gold buyer, record consumption of gold, not only by retail, but it's also institutionally. They've created a tax-free zone in Shanghai to become to induce and inspire North American and European banks to come over to trade gold. They want to become the global price maker, not taker. So there's a sea change going on with that, and they've recognized that if you want to have a global currency, that global currency has to have gold behind it. So there's been this increasing consumption. They produce the biggest gold producers a nation in the world, and they consume all of their own gold production. Nothing gets sold in the market, and they're the net buyer over 1,000 tons this year from abroad. So I think that that's important. Now, what does that mean down the road? Is if their currency becomes a global currency, then they're going to make the A shares and the H shares one. So when that happens, there's going to be this huge arbitrage.
All right. Well, it's certainly something else, and people could be buying the H shares now. It would make sense, huh? Americans can buy H shares?
It's a less risky way than trying to buy A shares or buying the A share ETF. You're paying a much higher PE, and you can turn around and buy the same companies that are H shares.
Okay, well, that's something to keep in mind. Good advice there, no doubt. Correct me if I'm wrong, Frank, but I believe the Shanghai exchange, is it a bullion-only, physical metal-only exchange?
Correct.
Yeah, so you can't play games with the paper markets there, as they may be played.
And the largest delivery of gold. So they're taking big bricks from America, they're going over to Switzerland, being melted down to smaller bricks and wafers, and they're showing up in China. So that's a very long-term tectonic shift, I believe, in the global gold markets. But coming back, I'll tell you a great story, because you and I feel the pain of these gold stocks. But,
sure.
And the same thing happened to a lot of people in the airlines. So you need new CEOs. So there's been over a dozen new CEOs in these big cap gold stocks, and I think they're becoming better stewards of capital, just like the airline industry is ahead of them in doing that. So it's possible that this move in gold, anything above $1,200, they've driven their costs down from $1,600 an ounce down to under $1,200. Anytime gold is above that level, it starts to throw up a lot of cash flow, and I think a lot of these companies are going to be much more respectful and better stewards of that capital.
Frank, you were hitting on the idea that China wants to have a reserve currency or the reserve currency. It seems to me that what we've had is what some people call a petrodollar that was orchestrated by Kissinger when he went to Saudi Arabia right after Nixon took us off the gold standard in '71. And some people are suggesting that a lot of the conflicts around the world have a lot to do with maintaining the petrodollar as opposed to and not allowing China, or let's say the BRICS, to oppose the existing order. What are your thoughts on that?
I really haven't delved into that, Jay. I can't really opine on that.
Okay, fair enough. Well, we have, of course, growing tensions with Russia. It seems Charlie Rose interviewed Vladimir Putin the other day, and some other leaders. How do you see Russia fitting into this? Are you invested in Russia at all, or is that a country
I have an
Eastern
European fund, and I left Russia last year and came back in January this year. So when Russia is basically emerging Europe. I have one of the first emerging Europe fund, and when you look at that area of the world, which was at one time one of the fastest growing emerging economies and highly educated. A big reason why we like that versus, say, Africa or Latin America is the level of engineers and scientists in this neck of the woods as a global trotter. But when you look at the world in Eastern Europe, 50% of the market caps are Russian stocks. 50% of those are energy related. When we do a screen of looking for cash flow, return on invested capital, these stocks show up as the cheapest in the world, like incredibly cheap. But they all trade off of Brent. So one has to be cognizant of, is Brent moving up or Brent moving down? Is it above its 50-day moving average or below? Because they trade with it, and so does the currency. So you can't hedge the Russian ruble. You can hedge the Turkish lira. You can hedge South African rand, but you can hedge the euro, the British pound, but you can't hedge the Russian ruble. So that is something one has to be aware of when looking at those countries. And the ruble is weak or strong, just like the Canadian dollar, based on the direction of the price of oil. Now, what happens? Go ahead.
No, go ahead.
So
we have about 3 minutes, and I want to get to some other things. But go ahead.
Putin wants to be recognized as this significant factor globally, and what's interesting is the U.S. with technology and fracking, we've surpassed him as being a significant player in the space of oil. So I think that Russia has its issues. It has nothing to export around the world except for trouble, it appears, or oil and gas. But highly educated people, yes, great people.
Okay, Frank, with just a couple of minutes left, I've got to ask you about gold. You wrote an article that appeared somewhere, I can't remember exactly where. Here's how much gold would be worth if it backed all the debt in the world. Talk to us a little bit about that article with 2 minutes left.
Sure. What I was trying to highlight was this incredible runaway debt in the U.S., and it's not only the U.S., it's Japan, it's in Europe, and for people to put that in context, because there is a thesis out there with James Targett's the world, is that there should be collateralized gold to debt ratio. They should trade in tandem. So gold is extremely undervalued, and if you wanted to make it back as a total global debt, as 100% of them backed by gold, it would be $33,000 per ounce. Now, do I think that's going to happen? No, because we have a banking system that doesn't function that way. But gold should be at least 1/10 of that, and that would be trading around $3,300 an ounce. So I was trying to put this in context for investors to recognize that the debt has run away relative to gold.
All right, Frank. Unfortunately, we're going to have to leave it there. Just one quick question, though, if you could answer in 10 or 15 seconds. Rate increase or not this year? Interest rates.
Yeah, I think it depends on PMIs. If global PMIs turn positive in the next 2 months, then rates are going to rise in the U.S. If they go sideways, no.
Okay, well, thank you very much, Frank. So much more to talk to you about another time, I hope. Thank you so much for being with us today.
Happy investing to all your listeners.